under the inventory sale case 2, we have already discussed very important things in the last session yesterday, and we have done a lot of calculations, and now we will look at net realizable value, and we will look at another part of that. Right, the new assessment is made of net realizable value in each subsequent period. Inventory hold in entity even after the end of accounting period. So that inventories, the value of inventories should value in future period also, subsequent period also, when the circumstances that previously caused inventories to be written down below cost no longer exist, or when there is a clear evidence of an increase in net realizable value because of changed economic circumstances, the amount of written down is reversed. That is, the reversal is limited to the amount of the original written down, so that the new carrying amount is the lower of cost and revised net realizable value. For example, right, so what it says means, right, so earlier in the last accounting period, the cost of the inventory was 100 rupees and NRV was 80 rupees. So then according to the LKAS, we have to choose the lower value. Here NRV is the lower value, so we choose 80 rupees as inventory in the balance sheet, and we have written down by 20 rupees. So this inventory is subsequently valued, so end of the accounting period. So this is the cut point, this timeline. So it was 31st March 2021. So at this moment the value of inventory is valued. Now the same type of inventory held in the entity, and say for example, right, now 31st March 2021, subsequent period, assume that the company is revalue the assets, revalue the inventories every year, for example, or we take every month, right? On this date, the entity was revalued the inventory. So now the net realizable value is NRV now is 110 rupees. NRV is equal to 110 rupees, and the cost was 100, NRV was 110. So this time we have to take the lower value of the inventory. So here we compare again 100 and 110. So we have to take this cost value, right? So earlier what was done, we have accounted for inventory. Inventory cost is 80 and written down expenses is 20. So earlier we have charged this 20 rupees as an expenses in the income statement. Now what they have to do is, So in the circumstances of reversal, so the NRV has increased. So that time they have to reduce this 20. So they have to say, for example, like this. So this is the account inventory value reduction, right? So here we have already credited 20. So so now again they have revalued at this date, and it should be cancel out first, right? So this 20 rupees should be cancel out, offset, right? So in the next month, 31st May 2021, the value of inventory cost is 100, NRV is 90 rupees. Then we have to reverse again the 10, and after that 95, for example, on June 30th June. So that time 5 rupees. So we have to reduce this 10 by 5. So like that, right? Any questions? Got your point? Have you understood? Any questions? Here, reversal, right? So when the circumstances that previously caused inventories to be written down, so due to the changes in their technology or changes in their demand in the market, so the value of inventory was go down below its cost. It means NR is less than its cost that time, so we choose NRV, the lowest value. So for that we have written down the cost, so that written down value will be charged in the income statement as an expenses. And in the future period, the value of inventory has increased. It means NRV is higher than its cost. That time we have to reverse, we have to cancel out the earlier expenses 20. So when the circumstances that previously caused inventories to be written down below the cost no longer exist, so there is now at present in the future period, in the consequent period, there is no such kind of uh, value reduction exists. They no longer exist. There is no longer the reduction of value exists. Now it's come normal, or sometimes the market value has increased of that uh, particular inventory. So when there is a clear evidence of increases in net realizable value, right? If we have a clear evidence about net realizable value because of changed economic circumstances, the amount of the written down is reversed, right? Reversed. Earlier we have charged 20 rupees as a written down cost, so this 20 rupees is reversed, it means cancel out. So that is, reversal is limited to the amount of original written down, so that the new carrying amount is the lower of cost and the revised net realizable value. So this occurs, for example, when an item of inventory that is carried at NRV because its selling price has declined, right? Earlier the price was declined in the market, so it is still on hand, the inventory is still on hand in a subsequent period, and its selling price has increased. So due to the COVID pandemic or other reduction in production, so it may happen, right? Clear? So when inventories are sold, the carrying amount of those inventories shall be recognized as an expense in the period in which the related revenue is recognized. Here we are talking about recognition as an expense. As I told you earlier, Say for example, the cost of the inventory is 100, NRV is 80. So what will be the treatment? So these 100 rupees will be taken into as a in the trading account. So closing stock we have to deduct from purchase no. So in that time we use this 100. When we show this inventory as an asset in the income in the balance sheet, we have to choose 80. In the balance sheet we have to show 80, and the difference 20 will be treated as an expense in the income statement, right? So when inventories are sold, the carrying amount of those inventories shall be recognized as an expense in the period in which related revenue is recognized, right? So here the carrying amount will be deducted. The amount of any written down of inventories to net realizable value and all losses of inventories shall be recognized as an expense in the period the written down loss occurs. The amount of any reversals reversal of any written down of inventories arising from an increase in NRV shall be recognized as reduction in the amount of inventories recognized as expenses. So already here we now 100 rupees inventory reduced to 80. So for this difference 20 already recognized in expense. So in case of NRV increases, this 20 should be reduced. Say 95, new NRV is 95. So this 20 should be reduced as 5, right? As 5. So in the period in which the reversal occurs, so that is reversal is limited to the amount of the original written down value. So that new carrying amount is the lower of the cost and net revised net realizable value. So again we have to follow the same formula. Some inventories may be allocated to other asset accounts. For example, inventory used as a component of self-constructed property, plant, equipment. Inventories allocated to another asset in this way are recognized as an expenses during the useful lifetime of the assets. You know, the entity is going to build a new office building, right? So they wanted to construct a new office building. For to construct, they have purchased bricks, right? There are a lot of bricks and steels and cement. So these inventory items will be used to construct the office building. So that time, so they have to include these inventories in their some inventories may be allocated to other asset account. Here in this cases, property building. For example, inventory used as a component of self-constructed property, plant, equipment. Inventory is allocated to other assets. So in this way, are recognized an expense during the useful life of the assets. So this cost, finally, this cost will be capitalized here in the building. Illustration 14, cost of inventory of a company was 100,000. The NRV value of the closing stock was estimated 20% less than the historical cost. So it means the cost is 100,000. How much NRV? NRV, how much? How much NRV? Net realizable value, according to this information?
80,000.
Yes, 80,000. That 80,000 will be charged. So 80,000 will be taken as NRV. So what will happen for that 20,000 reduction?
Should record as an expenses.
Yes, that will be charged in
The
the
P&L.
income statement. Now we move to the next area. So we will go a little fast and we have to go a long journey. The fair value is the price that would be received to sell an asset. When you sell an asset, how much you will receive, that is fair value. Or you paid to transfer a liability in ordinary transaction between market participants at measurement date. So when you sell the asset, how much you will receive, so that is fair value in case of asset. So in case of liability, so how much amount of money or how much amount of equivalent assets or other things you have to settle to close down the liability. So that is called fair value. So if you want more information about the fair value, you see Sri Lanka Financial Reporting Standard 13. Fair value. In the following cases, the inventories are measured at fair value less cost to sell. So it's what we can call it in other term, what, fair value less cost to sell. We name is what? It's kind of NRV, isn't it? Market price, market price minus cost to sell. So we call it NRV. So the cost of agricultural produces, produce harvest from biological assets. So paddy field. So at the time of harvest, so how do value the inventory? How do we value the inventory? Very simple. We have to find the market price and deduct any related cost to sell, so transport or the freighting cost, like that. So they may incur the drying cost for the paddy, so that cost may be deducted from the market price. Say for example, 2000 a bag of paddy. So to sell this paddy at 2000, it needs 300 rupees drying cost. So how much market price here? Fair value. How much? 1700. It's a value. So we have recorded, and the paddy per bag is 1800 as inventory. And commodity broker traders inventory. So there are some brokers we can find. What they do? So they buy inventories on behalf of others and sell inventories on behalf of others. Or some people, what they do, they purchase inventories at a lower price and keep the inventories for a period of time and sell it at high prices. It's kind of what, trading. Earlier one I told you, so they purchase on behalf of third party, so that is called what, broker. So commodity broker traders inventory, we will discuss in detail a little bit. Now just discuss about the first part, that is what, the cost of agricultural produce harvested from biological assets. So in accordance with LKAS 41, agriculture inventories comprising agricultural produce that an entity has harvested from its biological assets are measured, this is important, measured on initial recognition at their fair value less cost at the point of harvest, split off point, NRV. We have to take, we are not considering the cost, so the cost equal to what, NRV. So this is the cost of inventories at that date for application of this standard. So according to LKAS 8, LKAS 2, how to value the biological assets for agricultural output produces based on the NRV. Now we look at commodity broker trader inventory. Broker trader inventory. There are two parties: broker, trader inventory. So commodity broker traders who measure the inventories at fair value less cost to sell. The same formula, right? Cost to sell. When such inventories are measured at fair value less cost to sell, changes in fair value less cost to sell are recognized in profit or loss in their period of change. Normally these people buy, these people, the broker or traders, buy uh, the inventories. Say for example, they purchase at 1,800. So earlier we have done the calculation. So the fair value is 2,000, and the packaging charge or other cost is 300. Therefore, we take the value is 1,800, the price, and they keep the inventory, and they intended to sell it in the future date. Now the price has increased in the market. Now the price was say 3,000. So this difference is about 1,300 will be treated as profit. The changes in fair value less cost to sell are recognized in profit or loss in the period of change. No need to wait until it to make sales. When the price increases in the market, then they can recognize as a profit. No need to wait to record to until sell the inventory. So broker traders are those who buy or sell commodities for others or on their own account. So these inventories referred in the above paragraph are principally acquired with the purpose of selling in the near future and generating a profit from fluctuation in the price of broker traders margin. So why do they keep inventories? Why do they buy inventories? For the purpose of making profit arises due to fluctuation in prices. So when these inventories are measured at fair value less cost to sell, they are excluded from only the measurement requirement of the standard. So this standard will be applied. So there's another standard called agriculture undertakings. So it has a separate standard. So this standard will be applied only for the measurement requirement, right? Only measurement requirement. How to measure that agricultural inventories? For that purpose only, we use LKAS 2. So this standard does not apply the measurement of inventories held by producers of agricultural and forest product. Here this does not apply. Agricultural produce after harvest, mineral and mineral products to the extent that they are measured at NRV in accordance with well established practices in those industries. So each industries they have own valuation method, so they have to follow that methods to value the inventories. So when such inventories are measured at NRV, changes in that values are recognized in profit loss in the period the change. Same thing here applied repeatedly. The inventories re referred to the above are measured at NRV at certain stages of production. This occurs, for example, when agricultural crops have been harvested or mineral have been extracted and sale is assured under forward contract or government guarantee, or when an active market exists and there is a negligible risk of failure to sell. Here to value the asset inventories at NRV, the entity should have a reliable source of selling their inventory. Say they may enter into the forward contract so that a farmer agrees to sell a, a certain kilograms of paddy at 3000. So that's an agreement. So regardless the movement of prices in the market, so it gives a guarantee. It give a guarantee to the farmers. They can sell their products at the price of 3000. Or government, sometimes government give the guaranteed price, even though the market price fall down. There is a chance to there is a guarantee to that guarantee that they can sell their inventories to the government at particular price, or so there's a negligible risk of failure to sell. So there is low probability of chances which unable to sell their inventories at particular price. So these inventories are excluded from only the measurement requirement of the standard. So this is the summary I have explained to you in the previous class. So that's all about that presentation. Now we move to the next slide. Next part of slide. Can you see the screen?
Yes, sir.
New one, no? 3.3. This one new, right? New slide. Right now we move to the third part of inventories, LKAS 2, cost formula and disclosure requirements. So in this chapter we will discuss about how to value inventories. So LIFO, FIFO, and weighted average method. You might studied about LIFO, FIFO, BEM method in cost accounting and other subject, but here according to the LKAS you can follow only recommends FIFO and weighted average method, and the standard is not recommend to use LIFO, right? Not recommend. The LKAS 2 is not recommend use of LIFO, right? So the LIFO cannot be used in valuing of inventories. So right, cost formula, how to evaluate inventories. So when inventories are interchangeable items, it means the items are look same. Items inventories are look same. Say for example, paddy, the bag of paddy. So it's interchangeable, right? So almost same inventories are interchangeable items. Individual identification of cost is not necessary, and also it is not practical as well. So in the paddy market you can value, so how much per kilogram of paddy, right? You can't say this group of paddy, group A, group B, group C, or bag 1, bag 2, bag 3. You are not pricing like that, right? It's mean the paddy, house paddy, or rice, for example, rice. So it's almost identical, interchangeable, identical, right? So it's almost similar, homogeneous. So when inventories are interchangeable items, individual identification of cost is not necessary, and also it is not practical as well. In this situation, accepted cost formulas should be used to determine cost of inventories. So the accepted cost formulas mean FIFO, weighted average method. However, cost should be the actual cost if the items are not freely interchangeable items. So there are some items, the price, the cost of particular items are differ each other. Item 1, item 2, item 2, item 3. So their prices, their cost are changed. For example, in the petrol set, the fuel set. So the inventory of petrol, and inventory of diesel, and inventory of gasoline, inventory of oil. So they can't take all these petrol, diesel, gasoline. So they can't value at one formula, right? So these are not interchangeable. They are not interchangeable. But when you look at the rice mill, so there are a lot of bags of rice and paddies, right? There are a lot of bags of paddies. So there are 100, 200 bags. So these each and every bags are interchangeable. Each and every bags of paddies are interchangeable. And when you look at the gas cylinders, so all items are almost same, all interchangeable, right? So in that circumstance here, when items are not freely interchangeable items, then they have to use specific identification method. Specific identification method. Here you can't use FIFO, LIFO, right? Now we look at a specific identification method. Specific identification methods mean it cannot be interchangeable, right? The cost of inventories of items that are not ordinarily interchangeable, not ordinarily interchangeable, and good or services produced and segregated for specific project shall be assigned by using the specific identification of their individual cost. Um, where the specific identification method is not applicable, right? So not applicable, specific identification method is not applicable. In this context, the cost of inventories is valued by the following method. So FIFO and weighted average method, simple weighted average method. Here is an example, right? Here the first example is dealing with uninterchangeable items. So A1 is one item, A2 is another item, A3 is another item. So assume that A1 is a petrol, and A2 is a diesel, and A3 is a gasoline. But like that, it cannot be interchangeable. Received inventory received A1 1000 unit at 2 rupees, A2 1000 rupees at 3 rupees, and A3 at 1000 units and at 4 rupees. So this is how they purchase inventories. And from A1 they supplied 800. How many units balance? How many units balance?
200 units.
200. Balance 200. 200 into 2 rupees equal 400.
400.
Likewise, here 1000 unit purchase and supplied 700. So balance 300. 300 into 3, 900. Like that, 1600. So total value of inventory is 2900. So they purchased 3000 units totally, and they supplied 2100. Balance how many? 900. For that balance 900 items, value is 2900, right? So we have to value the inventories item by item. So if items are interchangeable, it means each and every items are look similar. each and every items are similar. Say rice mill, all the bags, paddy bags are almost equal. A1, A2, A3, right? Here they purchased 1000 unit at 2 rupees, 1000 unit at 3 rupees, the same thing, right? The same manner. Issued 2100, so they may supply it by here 800 or 700 and here 600, like that. So they can take this 2100 from A1, A2, A3. So what we do in FIFO method? What we do FIFO method? So purchase 1000. So we take what from this 1000 units, 800 units went out. Then balance 200, and then supply 700. So at that moment, the balance 200 will taken from here, and 500 will be taken from here, and third issue is 600 units. Finally, the balance how much? Here out of this total supply equal 2100, and balance how much?
900 units.
900. So that the price will be 4. Price will be 4 according to the FIFO method. According to FIFO, so 2100 issued from A1, A2, even A3, but the 900 balance is come from A3. So therefore the value of inventory is 4. So 2100 units supply. Here 900 units balance. 900 into 4, how much? 3600. An entity shall use the same cost formula for all inventories having a similar nature and use to the entity. For inventories with a different nature or different use, different cost formulas may be justified, right? If the items are not interchangeable and if the nature of the items are not similar, or each and every inventories are used for different purposes by the same entity, then we cannot use common one, right? So for example, inventories used in one operating segment may have used to the entity different from the same type of inventories used in another operation department, right? Say for example, this is a company A. It has two departments, X and Y, X and Z, X and Y. So a particular items are used by department X, another particular items used by department Y. So these instances they have to use a different cost formulas. However, differences in geographical location of inventories, that is right. So one in Colombo, one in Jaffna, one in Kandy. So in that time, even though the locations are indifferent, but the items are interchangeable or nature of the item inventories are look similar, homogeneous items, and it used for the same purpose, then the different formula is not recommended. However, the difference in geographical location of inventories or respectable tax rules is mean one geographical location, so one particular country by itself, is not sufficient to justify different cost formulas, right? So here if it is interchangeable similar items in nature, they can choose FIFO, LIFO, WEM method, not LIFO, FIFO and WEM method, Otherwise they have to use the different method. Different method mean what? Specific cost. Specific cost. FIFO. So I don't want much time on this. All of you may expert on how to calculate inventories using FIFO method. So this method assumes that the goods that were received into the stores at first are also issued to production or sale at first come first serve basis. Like if inventory comes first, that inventory will be supplied to the production department or sales unit, right? uh, the movement of inventory physically it's not exactly first in first out, but the pricing method is first in first out. It doesn't mean physically those inventories should move first first in first out method. Accordingly, closing stock will consist of goods received at last and therefore valued at the price of last purchase. However, it should be noted that physical issue of goods shall not necessarily based on the first in first out basis. So that is, you can send goods in any discipline depending on the feasibility and the requirements, right? So first in first out mean actually it's a pricing method, not the physical movement of inventory, right? So even though if you purchase last and you can supply first, but you have to put the price at which you have purchased earlier, the price at which you have purchased earlier according to the FIFO formula. So this is the example I have taken. This example from chartered book CA Sri Lanka. It's very easy. So can you have a try on this? Can you calculate inventories on FIFO method? Can you calculate inventory here? Opening balance and receipt issues and receipt, both of them are here. Can you calculate this? I give you 5 minutes. So you don't want to worry about this one, this column and this column. You don't want to worry about. So the need information is this and this. Can you calculate the closing balance of inventory?
Yes,
Yeah, please.
sir.
Right, if you got the answer. Have you got the same answer as this?
Yes, we got the same.
Yeah, good. And can you do it in the WEM method? It's very easy, right? Can you do it in WEM? Simple average method. So in WEM method, there are different methods applied. Here in LKAS, to it explains very simple weighted average method, not weighted average. Simple average method. To the same question in WEM method. So it's take time. Right here, the opening is to 100. The price of item is 20, 2000, and here on third item purchased at 21 rupees. So therefore, total value of here, right? And the issue 200 units. So how to make pricing? Simply, what to do? We have to take this value 10,400. So how many items here? 500 units. So 10,400 divided by 500 units. Then it's equal 20.8. 20.8. So that value will be taken as a supply price. So the cost is 41,060. So this value should be deducted from this value, right? And we can take this value. So this is the process, right? It's very simple. No need to memorize from which item, which quantity of things we have consumed, right? Clear? So according to the WEM method, value of inventory equals 4,400. So this is another example. So we can work out on this. You are required to compute the closing stock as at 31st December 2018 based on the FIFO as well as weighted average method. So you can do it by your own. If you have any issues, you can contact me. And this is a little bit different, but yeah, the question is using appropriate cost formula, calculate the cost of closing stock of Abirami Limited if the above items of inventory are ordinarily, number one, interchangeable. So interchangeable means you can use FIFO method, FIFO, or you can use WEM method. If and second circumstance, if the item is uninterchangeable, it means each and every items are different. Say for example, this is item A, this is item B, item C, D, E, like that. So when we calculate the inventories on the circumstances, so 1000 units purchased and 800 units supplied. So how many balance? Balance? How many unit balance? A1.
200 units at 2 rupees.
Yeah. Then we have to take that value here 400. here 300 balance, so 300 to 900. So likewise we have to calculate for each row and we to make it total, right? So this is very simple, right? So cost of inventories when its calculations is impractical. Calculation is impractical. So the following techniques can be used to ascertain the cost of inventories if the calculation of cost is impracticable. Sometimes it's difficult to calculate the value of inventory. So think about grocery shop. So there are different items and they may purchase at different time interval and price may differ, right? It's impractical. So they may be used to convince if the results approximate the cost. The first method is standard cost method. Standard cost. The standard cost take into account normal level of material and supplies, labor, efficiency, and capacity utilization. So they are regularly reviewed and, if necessary, revised in light of current situation. So they use standard costing. You might study about standard costing in cost accounting in detail. Second method is retail cost method. The retail method is often used in the retail industry for measuring inventories of large number of rapidly changing items with similar margins, for which it is impracticable to use other costing method, retail method, right? Uh, so the cost of inventory is determined by reducing the sale value of inventory by the appropriate percent of gross margin. So what can they do is in the retail cost method, they estimate the selling price, market price. So there are bulk of items, and for that bulk of item they fix a price, retail price, for how much a uh, particular inventories can be sold at the market, say 50,000. And how to estimate the cost? We know the selling price. How to estimate the cost? And we know that the margin, is a 10% margin, 50%, 15%, 20% margin. So simply deduct that margin and we can easily calculate the cost. The cost of inventory is determined by reducing the sales value of the inventory by appropriate percentage of gross margin. So for example, if the price is 100, gross margin is 20%, then we reduce 20, then easily we get 80 rupees as a cost. The percentage used takes into consideration inventory that has been marked down to below its original selling price. An average percentage for each retail department is often used. So specific identification of cost means that specific costs are attributable to identified items of inventory. This means the items are not interchangeable. So this is the appropriate treatment for items that are segregated, not aggregated, segregated for a specific project, regardless of whether they have been bought or produced. However, specific identification of cost is inappropriate when there are large number of items of inventory that are ordinarily interchangeable. So if the items are interchangeable, they cannot use specific cost formula. In such circumstances, the method of selecting those items that remain in inventories could be used to obtain predetermined effect on profit or loss. So the disclosures according to the LKAS 1, LKAS 2. So what are the accounting policies adapted to measure inventories, including cost formula, whether it's FIFO method or WEM method or other specific cost method, the total carrying value of inventories and its classifications, the carrying amount of inventories at the fair value, so NRV, right? The amount of inventories recognized expenses if there are any written down, so that should be disclosed. Amount of written down value of inventories, amount of reversals of any written down, the circumstances of events that lead to reversal of written down. So you have to explain the circumstances also, and carrying amount of inventories pledged as a security liabilities. So that's all about LKS 2. In the next class we will start LKS 7, cash flow statements. Right, LKS. Meanwhile, if you have any doubt, you can ask. Otherwise, we will wind up the class. You can leave the meeting. Any questions?